Satish, thank you so much for coming on to Startup Steroid today. I'm really excited to learn about Top Shelf. I think you have a fantastic strategy and you're making some great investments. So hopefully we can discuss that today. And then we'll also discuss maybe a little bit of your background because I think starting in IT, going into investments, I think is a really interesting path. So I'm hoping to learn all of that today. But before we get into the specifics, let's start with a quick introduction. Tell us a little bit about yourself.
So 1 year ago, we started TopShelf Equity Partners with the goal to democratize the VC investing. So so far, as an enterprise architect, my job was to find a right tool for the solution we are building. So most of the products we chose are really, really good products, and they're not public yet. They are still in private, so in the VC stage. So I think companies like Snowflake, MongoDB, ServiceNow, and these companies are extremely good. And we analyze these companies and then pick those companies as solutions for the problems we are trying to solve. And then when I saw the news, all these companies are getting listing with with the good valuations. So that's when I realized, okay, so we know the companies are good, and even before they went public. And then, is there a way for us to invest in these companies? So I tried to do the only simplest way I knew was get a job in the company, get stock options, and be part of that company. And but with that approach, I cannot scale myself. I can get job only in one company. So then I started realizing, okay, can I invest my money in these companies even before they go public? But my check size is too small. So then how can I solve this problem? I like 10 different companies, and I really, really want to invest in those companies because they have the real product, real revenues, real use case, and they provide extremely good value at a fractional cost to the customer. And the retention is extremely good. They fit in the ecosystem, in the solution we are trying to build. So then I said, okay, how can I put my money in these companies? So that's when I started realizing, and then we looked into various opportunities and started exploring, talking to the people, talking to the CEOs and stock admin teams and all those folks. Then we realized that it is possible to invest into those companies, but you still have to come with bigger checks. So with the help of my brothers and family and friends, so we started collecting funds and then acquiring these stocks in in 6-digit numbers. And that's how we started TopShelf Equity Partners. Before this, I was trying with my own money to see if this works or not. I got connected with some, the C-suite, employee of the SoFi, and then we acquired close to, $100,000 worth of stock. And then 6 months later, the company went public. So that's when we started, analyzing the companies, valuations, and then raising money and acquiring the stock, and then try to democratize the VC investing.
I think this is such a fantastic way to sort of learn about the companies because you were looking at the companies as a customer and got to know them, got to realize, see that this is the best product, this is the best price point, all of those things that a customer would look for. And once you recognized it, obviously that company is going to succeed because they're the market leaders, right? So I loved how you sort of started analyzing companies. So you were doing investing well before Top Shelf started, right? So your first investment was probably close to 6 years ago, I think. Tell us about that investment and what those early lessons were for you.
Okay, that's a great question. So 6 years ago, when my friend came and said, I wanted to build something, right? So that's when group of my friends, we talked on the Zoom call. And then we said, he explained the problem he's trying to solve, what is the opportunity. And then we are really convinced. And then we said, okay, let's explore. And that's how we funded, the first angel investment. At least that's my first angel investment. And the company is called Automate.io. 6 years ago, And since then, my friend Ashok has done great job in building the company. And recently, the company got acquired by Notion. And
Mm-hmm.
Notion is a business, the productivity solution company. So that's my first angel exit.
Fantastic.
Thank you.
See, when you have a great experience like that, now you can actually see the possibilities. So that's fantastic. Tell us about other experiences before Top Shelf.
So prior to Top Shelf, I did 3 years ago another angel investment in a company called Monsoon Credit Tech. So they provide the data points to the bank so that they can predict the lending, the borrower capacity to say if they can repay the loan or not. And that product seemed really interesting to me. And then I really like the founder and CEO. So I made a good investment in that company, and it's working out pretty well. So, and those are my two angel investments. And then I also invest in the technology companies that I know that are listed. It's easy to access. You just go to any brokerage account and then you invest. So some of my
Mm-hmm.
companies did extremely good. Um,
Yeah,
yeah,
no, that's fantastic. So last year you said, okay, now this is working. That these investments are
yeah,
already paying off. You started Top Shelf, but the idea was to invest in more mature companies, not the angel
right.
investing route. So tell us about that initial thought process for sort of the pre-IPO style companies.
Right. So just before Top Shelf, we started Top Shelf. I wanted to try if this, investing into the late stage companies really work or not.
Right.
So I know I found like a couple of companies, and I said, okay, let me try to invest in these companies. So I started with Palantir, and then we got into that company way, maybe like 6 months before it went public. And then Confluent, which is another my favorite company. It's a enterprise support for the Apache Kafka. And then I like that company, and then I entered into that company. And then we got into Robinhood. Most of Robinhood. And then so all these four companies, we took a position sometime in July 2020. So 1 year later, all are public now, giving me like close to good returns. I don't know if I can say it or not, but extremely good returns.
Yeah, all four of these
So
are household names now, so I don't think we have to discuss the returns. They're very healthy
yes,
returns.
yes, it's pretty good, healthy returns.
Yeah.
And so in November, I realized how can we scale it. So I solved my own problem. You know, of investing lower size tickets into the late stage companies. Then how can I take it to my friends? So that's when we identified another company called Automation Anywhere. And then we tried to raise the funds. And then because the Automation Anywhere, the opportunity is so good, we were getting the stock at the same at the $7 billion, as same as the previous round. And
Mm-hmm.
then the in comparison, there's a company called UiPath.
Mm-hmm.
That was about to go public, like extremely high valuation. So we immediately saw the opportunity and then analyzed the company Automation Anywhere, like just like you do. You go to their community edition, sign up for their product, and then do some coding. Talk to the people who are actually developing the product. I talked to the people who are selling the product, and everybody said good things about the company. So I really like the company, and the valuations are extremely good. And then we work with the company to secure their stock, and then work with the security attorney to create a vehicle so that uh, people like me can invest in these funds. So that's when we got the idea of, can we democratize this VC style investing? So it worked really well. A lot of my friends who trusted me, they participated in the Automation Anywhere. And then since then, we did a lot of funds. Like we did the ThoughtSpot, which is another good data
Mm-hmm.
visualization company. And then we did Rubric, and we raised funds for the Kraken. And then well, recently we participated in the primary round of the people.ai. So that's how we are right now at $20 million under assets under management. Yeah.
Fantastic. I mean, that's such a exciting year so far, and you're just getting started. But I do want to learn more about your sort of thought process before you're actually making these investments. You sort of touched on, what things you look at. Obviously, product being the primary thing. But how are you doing the due diligence? How are you analyzing these companies? Tell us a little bit more.
Okay, so first because I'm the technology person, I work with a couple of my friends, and as I told you, I'm from Triple IT Hyderabad, and I have many friends who are in the technology field. So I try to leverage most of these friends, and then see, once we identify the opportunity, and then look at the company, then we do the research in many folds. Just like what I used to do as an enterprise architect: is the product good? Can it sustain for long? Who are the competitors? Why is it better than the other products? And then is it really what it is saying about the revenues? And we check the customer stickiness, we check the annual contract values, and we check with what type of partners this company is actually engaging to sell their product, and what are their revenue models, what are their subscription models. So, and who is the leadership behind the, developing these products, or the running the company. So we check so many parameters, and I talk to so many people in the company, and then that's how we come to the conviction, and then check the valuation, and that's when we take a decision. So that's how we pick the companies.
That's fantastic. So let's talk about the valuation specifically, because I know that that is a sticking point for a lot of people, because right now, valuations are just going crazy. How do you decide if, companies A valuation, we don't have to talk about a specific company, but in general, how do you decide if companies A valuation is good for you to make an investment versus company B, which might have, a much higher valuation, and is probably something you want to stay away from?
So the valuation is pretty interesting. So one barometer is like, how many rounds of investment, how many series fundraisers the company did, like, series A, series B, series C. What is the last round valuation, and how much money was invested, and who invested in the company. So that's my metric. So based on that, how much value am I paying right now? So now check what is the duration. If the company is valued like $1 billion few months ago, and I tend to pick a company, even if that is good, between 1 billion to 1.5 billion dollars, like plus or minus 20%. But if the company was valued $1 billion 3 years ago, and it could be like $10 billion, $20 billion, in that scenario I check, can I pick another company, listed company, to make apples to apples comparison, right? For example, UiPath at $28 billion, Automation Anywhere, we were getting it like, $7 billion. So is it really 1/4 of the company? No, Automation Anywhere is like, as in my view, it's as good as the UiPath.
Right.
So then that's how we compare the valuations, and then pick the company.
Got it. That's a perfect example where you immediately on the day of investment, you have a 4x possible return built in
Yes.
without even company growing. So that's fantastic. So now let's continue on. What kind of deals are you looking for going forward? Um, you
So our sweet spot is technology, SaaS companies. That's what we understand, right?
Mhm.
And so we tend to pick a company that we can understand. So the biggest problem with these companies, the private companies, is you don't have access to their revenues. You don't have access to their valuation. All you can see is the product. You can feel it because you can use it. You can get the demo, and you can talk to the people who are selling the product, and then you can see what are the value of the contracts and all those things, and then you can see the Gartner reports. And then, so because you don't have the exact top line, bottom line numbers, but there's a risk. How you mitigate the risk is your knowledge of the product, your understanding of the company, and then the research, the technology, what they are doing, and the problem they are trying to solve. And you can predict what's their runway. And based on that, I pick the company. And sometimes I have to compromise on the valuation. For example, if you look at the company called Databricks, 2 years ago it was like $6 billion. And 1 month ago, they raised funds at a $38 billion valuation. They raised $1.6 billion. So now in 2 years, the company is like 6 times.
Right.
So it's a very, you have to put a lot of factors into the equation and then take a decision whether to invest or not.
Right. So that's actually a perfect example where if a company has grown, 6x in the last 2-3 years, do you see, again, when you are making the investment, you are looking for certain type of return, 5x, 10x, whatever return that you might be targeting. Do you at that point now have to see if there's a possibility of that 36 billion dollar company going to 150 billion dollars to get your 5x, right? Do you sort of forecast that kind of future?
For some companies we do, for some companies we don't do. So for a company from, this is what I believe, right? For a company to grow from 100 million to 200 million dollars, maybe it's easy. For a 35 billion dollars company to grow to 150 billion dollars company, it takes time because you are moving a lot of mass, right?
Yep.
So I usually tend to see what are the better opportunities. If not this, then what else I have. Right. So that's when, recently we started moving into companies like in Series D plus stage, right?
Okay.
And it's interesting, I want to talk about this. You asked about the valuation, right? How you pick the valuation. And I want to talk on those two things again.
Absolutely.
So recently we participated in the People.ai, and then we co-invested with, other big tier one VC people, VC investors, right? So they have information, access to advanced information, so they can analyze the company, and they are valuing the company at $1 billion, and that's the same price we are getting into. So we sometimes lean on the big brothers to see, okay, so $1 billion is good, let's invest in it. So that's one way we actually, do the valuation.
Absolutely. And those guys have insights, insights into the financials, insight into the team, insight into the future strategy that you as the smaller investor in the round may not necessarily have.
Exactly. And that works well for if you are participating in the primary round. But if you are doing the secondary, then that's a little bit difficult. So that's where I mentioned, you check what's the previous valuation, how much time it has elapsed, and what are the comparables, things like that.
Okay. I mean, there are a lot of factors there. So let me ask you this question. So now that you sort of figured out what company you want to go after, you've sort of tested the product, tested the market, making sure this is the right company. How difficult, or what is the process of you getting an allocation that's significant for your investors? Access to those CEOs or executive team to actually come and talk to you, do the due diligence, etc. What has that process been like?
Okay, that's interesting question. So it actually, if you're approaching an early stage company, people are always approachable. They are willing to talk. So I do so many cold emails on the LinkedIn and just message. I do research on the company and I say, hey, I want to talk about this. Do you have a few minutes? And so far, I reached out to so many people, and everybody was willing to talk about the product. And that's on the early stage. On the mid stage, so I use contacts of my previous relationships to my friends or people who I work with, and then I talk to those people and then get introductions, and that's how we try to get the allocation. And for the late stage, it is extremely difficult to work with to secure the allocations, because here what we do is we provide liquidity to the employees. So somebody in most of the technology companies, in the high growth technology companies, they give the cash component and also the stock component. And the stock is illiquid for them until the company goes public. So that's when we approach the company, hey, we want to provide the liquidity to the employees. And then and then we find the employees or the people who want to get some dollars for buying a home or do
Right.
whatever they want to, and then we try to enter into the agreement and work with the company to get the stocks transferred to Top Shelf.
Oh,
In
okay.
all the late stage companies we are always on the cap table of the company we are buying it. So we never do
Nice.
fund of funds. We don't invest in some
Right.
XYZ fund that owns XYZ fund and that owns the ultimate stock.
Right.
Because here, what we believe is, because most of my investors are like, they trust Top Shelf. And then the way we can mitigate the risk is we directly work with the companies. And then when we purchase the stock, we are on their cap table. So that's how we, there's a whole, like, some companies have a 20-day, 30-day offer process. So
Mm-hmm.
we enter into the agreement and the company says, yes, you are good to go. And then the board approves the stock transfers. And that's how we get into the cap table.
Right. That's fantastic, and I love the idea of approaching the employees first, and because you're not looking for $100 million, you're looking for 2, 3, 5, 10 million. So
Correct.
that allocation you might be able to get from an employee or several employees versus approaching the company directly. So I love that
Right.
strategy. Um,
Exactly.
so we've sort of touched on a lot of different aspects of investing and your strategy. Is there something that I haven't asked you that's really important, that's critical to the story?
Maybe the way we structure the products is, again, I said, right, our mission is to democratize the VC investing, right?
Hmm.
So the way, what we try to do is, the name itself is Top Shelf, is like, you go to Walmart, you find the best product at the top shelf and you pick it and you go. You don't
Right.
spend research on, like, how this chewing gum is made, what does it
Right.
do, how much have I. So that's the kind of products we are trying to build. So the way the structure works is, we create a fund, and all our funds contain only one company at that particular price. So if you like that portfolio company and you want to get to access to that company, so you buy the interest in the fund, and that fund owns the stock. So you are indirectly owning the stock.
Hmm.
So in this whole process, the investment is, I have to mention this, the investment. So you are relying on the valuation of the company, and then your investment is illiquid until the company goes public. And
Right.
then you hope that the company continues to grow in the double digit or triple digit or whatever we, see on the research reports. And then once the company goes public, after the lockup period expires, that's when you get access to the funds.
Right.
So the cautions, the risks, I would say, in this type of investment is, one is the money is illiquid. Two, you don't know for how long it is illiquid.
Yep.
So number three, you are investing based on, because all the profit and loss statements are not available like a listed company. You may not have access to the full the financial numbers. So so that's the risk you are willing to take.
Right. No, and that's really interesting. Let me ask you this. This is, as an investor, I know that a lot of times when the lockup period ends, usually in that week or in those few days, valuations may take a big hit because everybody's liquidating, everybody's exiting, or there might just be huge fluctuations where you don't really know your exit point. Do you have a strategy to deal with that, or is that the rule? Like, as soon as the lockup period ends, we exit?
Um, okay, so this is interesting. So yes, most of the technology companies, when the lockup period ends, a lot of people dump the stock, and then the stock price may go down, and sometimes it may go up. But for all the four investments, four exits we did, like two of them, on the post lockup, they did go down, but
Mhm.
still we made good IRR. So
Okay.
based on the valuation you are entering, if you are comparing that with your exit value, it is
Right.
still good return.
Right. Right. Right.
So yeah, after the company, the post lockup period, then pretty much we don't add any value. The same stock, you can go to Robinhood or Fidelity or any brokerage account, and then you can buy the stock. So that's when we end, and then say we realize the profits.
Right. And that's a great thing for the investors to know also, because if they want to stay in the stock, they can just buy it at the open market. There's
Right.
no reason for Top Shelf to hold that stock. Um,
Exactly. Yeah.
Perfect. So now let's, I always end with the same question, that if there are founders, if there are CEOs watching and they're listening to you and they want to get an investment from you. So Satish, what is the one thing the founder has to do?
Okay, so maybe it's a couple of things. So this is coming from my personal experience, right? So before, if there's an entrepreneur who is coming to me to, for my check, and this is what I expect. Um, I want to because we understand that there is a high risk in investing in any company in the early stage, right? So we assume the risk. What I want to hear is the true intent, the true roadmap you have, the exact thing that you want to do, and if you can articulate that without having to please any check writer, I want to see the true actual thing that you want to build. So that's before you get my check. And after you get the check, I probably like to get maybe an update in 6 months, and never be hesitant to deliver the bad news. You can tell the good news, you can tell the bad news. The bottom line, I would say one thing is never try to please the check writers.
Yeah, that's a great point and really well said. Uh, we're essentially your partner. So we want to know exactly what's going on. Don't try to be a salesperson with us. That's not necessary, right?
Exactly, that's right.
Fantastic. Satish, thank you so much for coming on today. I really appreciate learning about Top Shelf and what you're doing and your wisdom. I think we definitely have some deals in the future, so we'll be working together on those. But thank you so much for coming on today.
Thank you, Dawal. Pleasure is mine.